Hello everybody and welcome back to Equity Maximalist. Today I thought we'd talk about what type of investor you should be. It's a broad question, I know, but we'll look at some examples of type of strategies that exist out there, and then we'll look at some examples of people that employ these strategies, and then lastly we'll try to create some criteria that may help you define a strategy for the market today. And hopefully you can stick to the strategy, employ the strategies, get better at these strategies, and then make money from them. This I think is a very important step that most investors actually skip. They try to do too much, and it ends up hurting them in the long term. As Warren Buffett says, the market does not require an excess in intelligence, but rather I would say an excess in temperament. Now, what does that mean? Well, it means you must be able to invest in stocks despite your emotions. People are going to tell you to be emotionless when investing. This is a hard thing to do. So at a minimum, you must be able to invest despite your emotions and let logic define your moves, not emotion. With that being said, let's jump right into it. So first, we must understand the type of investors that are out there. Investing, quite literally, is defined as putting up money somewhere, whether it be in shares, property, financial plans, or new commercial ventures in hopes of achieving a profit. In the equity market, we are largely associated with stocks and the derivatives of those stocks like options. Based on my outlook of the market, I think there are four types of investors that can be summarized in the gambler, the analyzer, the optimist, and lastly, the skeptic. So let's go over each of them and see where you fit. First, I want to point out that you don't have to limit yourself to any one of these categories. You can do a mixture. I placed them in descending order of risk. So think of those four as a spectrum and you get to choose where you're playing at. So first type of investor is the gambler. This is what I would say a lot of new investors, especially in current times, start at. I was even hesitant to include this as a type of investing really, because it really hardly is even that. But since I think so many start here, it's important to understand it. The gambler is one that invests in stocks without any fundamental reason to. They are largely basing their strategy in hype. They may have read somewhere that a certain biotech company would get FDA approval for a cream that will solve your foot fungus issue, and now you must invest in that company. They hardly ever look at financial sheets or understand the underlying company, and most of the quantitative analysis revolves around looking at the stock chart more than anything else. If this sounds like you, don't fret. I think it's the first landing of investing for a lot of kids these days, and honestly, as long as you are up to learning, you can become a better investor almost overnight with some structure. The second type of investor being the analyzer. I think this tends to be the second level that most investors go through. It is the one of the analyzer or the technical analysis investor. Now, I want to make something clear. Technical analysis, in my opinion, is a real thing. It is a real thing because so much money believes it is. This means the market will trend towards algorithmic trading with arbitrary support lines and moving averages, mostly because of a lot of quant trading volumes coupled with smaller volume traders make this a reality. I do think you can make money from this, and I don't want to say it's not real, but to do this well and do it consistently, I think it's a hard task that I think 99.9% of investors should stay away from. To go a little further into this type of investing, you are again not looking at company fundamentals or even any real underlying company data. Your investing strategy is based on movements of charts. The underlying company to you is irrelevant. For this reason, I have placed it next to the gambler because I think it again does not rely on the company, and I want to make something crystal clear to invest well and to invest consistently. Your best bet is to look at companies and not at their stock charts. There is a way to use this type of strategy to improve your skills, and we will discuss this in a little bit. The third type of investing being the optimist. This is where I think a lot of investors that are not traditionally trained are. They look at companies, they look at fundamental values, and they trade on the prospects being above the historic trend line. What that means is that they are investing in the promise of the future. A new product launch, a new geographical expansion, new merger, or something along those lines. This also tends to be where many growth companies find their ideal investor. Risk is higher as it is a promise of a brighter future, but returns are also there if you are guessing correctly or investing correctly. Now, these types of investors do have a very broad range. There are some that are more akin to the gambler in this group, and there are those that are closer to the skeptic. What that means is that while some will look at valuations, others will choose to ignore it in the hopes that an underdog product can save the company. Then there are those who pay higher premiums on current earnings, understanding that the company has a good chance of generating future cash flows that are much more significant than current values. Valuation always matters. If a company is trading on anything above a 5-year growth estimate, it most likely isn't valued well. So please, while I also operate in the space of investing, it is important to understand to do this well. We can't throw the concept of value out the window. I'm looking at you, Kathy Wood. The last type of investing is the skeptic. This type of investor relies on historical information and stays below the trend line as a margin of safety and picks the best companies to invest in that scenario. What that means is that they do more analytical analysis of the company, creating discounted cash flow models, looking very critically at historical growth, baking in some margin of safety and projecting models. These guys tend to be more traditionally trained eyes. They are more focused on relying on the past to predict the future. This is the type of investing you see a lot of historically successful investors do, and is more akin to be known as value investing. This is something that most people with the right temperament and a little knowledge base can do, and where most people should operate. Warren Buffett, Charlie Munger, Benjamin Graham are some names that play in this space, or have played in this space. Here, you are minimizing your risk while also minimizing your return. Warren Buffett, the greatest to ever do it, averaged a roughly 20% annualized return, possibly the best number that you can see for a large amount of money that he controls ever. The S&P doing something around 10.5% in the same time. So if you don't want to do extra research, if you don't want to do the extra level of effort it requires to pick stocks, the best bet that you can do is track indices. What that means is you buy low-cost ETFs and invest your money with almost no need for external research. You are investing in America and the world largely, and these tend to do well. However, by choosing to be an active investor, you are taking on more risk to beat the market, and this, again, is inherently a risky thing to do. So now that we have looked at all types of investors, let's discuss which one you should be. Well, as I mentioned, while I define these categories, they are not hard rules. You can pick and choose things you can learn from each of them. The foundational things is that all investors must do is always look at financials. Please understand the finances of the company you are buying. Look at how much cash they have, how much debt they have, how much cash flows, income, or even losses, and find the context of those numbers. Once again, numbers without context will lie to you guys. If you are on the younger side, you should have a higher risk appetite for risk. Thus, you can take two valuation metrics from the skeptic and use them to navigate being an optimist. What that means is that understanding that half the game of investing is paying the right price, not about picking the right company. Let your heart be optimistic, but your mind be skeptic. By doing this, you can operate, in my opinion, in a space of great returns. Again, these do come with higher risk, but doing them well can return a higher return. You can also take from the analyzers for entry points. What that means is that whether we like it or not, technical analysis tends to correlate to reality purely because of self-fulfillment. But we can use this to our advantage, sometimes, not always, to make better entry points, to potentially buy cheaper. This is an extra trait you can take from analyzers, but you don't have to. The benefit you have of doing this is with a company you want to invest in is that if you are wrong and the stock goes down more, well then you got a better deal than you expected and you can buy more. If you're older, your job most likely is to preserve wealth, so your risk tolerance should be much lower. You should follow the path of the skeptic. If you want to take on a tad bit more risk, but largely you should think of balancing your portfolio with stable ETFs that revolve around value, dividends, and consistent growth. The type of investor you are depends on who you are, but everyone should always look at financials to make sure valuations are reasonable for future prospects. Once again, half the game is paying the right price, not buying the right company. If a stock has already baked in 10 years of growth, then what's the likelihood that you're going to make money on that stock in 10 years? Very little. So please guys, always make sure to understand the value of the company you're buying and make sure it's reasonable. Thank you guys. If you liked or enjoyed anything that I had to say, please like and subscribe. I'll see you soon. Bye.